We all know the feeling. It's late, you're exhausted from work, and staring back at you is a sink overflowing with dishes, or a bathroom that desperately needs scrubbing. The daily friction of household chores is universal. Enter the modern solution. Platforms like Urban Company, Pronto, and Snabit have built entire ecosystems around instantly dispatching a professional to your front door to do that heavy lifting for you, and they are offering it at an incredibly steep discount. You can get an entire hour of physical labor, complete with travel time and corporate management, for just 99 rupees. Consumers are happily taking the deal. Across these platforms, a staggering 1 crore active users booked services in the month of March alone. But if you actually run the numbers, the transaction stops making sense. A worker's physical travel logistics combined with intense manual labor simply costs more than 99 rupees. This visualization shows exactly what happens when that math breaks at scale. While you pay a tiny 99 rupee fee, Urban Company recently posted a quarterly loss of 161 crore rupees, which forces the question, who is actually subsidizing your clean house? To understand massive corporate losses, we have to scale down and isolate the microeconomics of a single gig worker knocking on your door. This bar chart reveals the hidden data. For every 99 rupees you hand over, the company secretly spends 450 rupees to fulfill the service. That means the company actively chooses to lose 351 rupees on every single transaction. They aren't doing this by accident. In the industry, this is effectively an adat bigardna strategy. They are intentionally spoiling you with artificially cheap labor to build a daily, unbreakable behavioral habit. Startups view this 351 rupee deficit as a strategic down payment on your future habits. They are subsidizing your lifestyle today to ensure they own your domestic routine tomorrow. If a local mom-and-pop cleaning business tried operating with those margins, they would burn through their cash and file for bankruptcy in a week. But the venture capital ecosystem operates on an entirely inverse logic when it comes to early-stage profitability. Look at this dual-axis graph. On one side, financial losses are plunging deep into the red. But on the other side, investors are pouring so much money into these platforms that the company valuation is aggressively trending upward, recently crossing 20,000 crore rupees. Venture capitalists are actually instructing founders to take the funding and intentionally stay in the red. In the high-stakes startup world, short-term profits are a distraction. Investors will gladly fund hundreds of crores in quarterly losses, so long as those losses effectively secure monopolistic user addiction. To see exactly what these venture capitalists are trying to buy with all that cash, we need to zoom out to the entire national market. This grid represents the total potential consumer base. Serving 1 crore users in March only fills 2% of this market. 98% remains completely untapped. That 20,000 crore valuation is a forward-looking bet. Investors are paying upfront to conquer that vast blank 98% territory. But here is the catch. Once market dominance is achieved and all the local, independent competitors are starved out of business, the venture capital subsidies will immediately stop. To recover their extreme acquisition costs, these new monopolies will have to dramatically raise their prices, and they will do it to a consumer base that has completely forgotten how to clean their own homes. These 99 rupee bookings represent a temporary distortion in the market. The venture capital covering the difference will eventually dry up, leaving the consumer to foot the bill for the full, unsubsidized cost of the service.